All right, what is up, traders? What's up, tycoons? Super excited for today's video. Going to break down a lot of important economic data, macro data, different things like that. We're going to start off here with card spending. So if you take a look at retail X auto spending was down 1.1% year over year. Year over year, total card spending per household came in flat in the week ending in October, according to Bank of America's aggregated credit and debit card data. So that's basically a summary of what it is that you're looking at on this chart. For you guys, if you basically can't interpret this chart, right? We're seeing new bankruptcy filings have been rising since early 2022. I've mentioned this multiple times in a few different videos. We're just seeing lots of bankruptcies, or we're just maybe not so much, but we're just seeing a continuous rise in bankruptcies. And I know a lot of people are scared about the economy. They're scared that a recession is coming. But when you take a look at the overall trend, it's definitely been a downtrend. But if we were to just, not to do technical analysis and overkill on technical analysis, but, we're trying to essentially break, all right, this downtrend right here. And we're starting to get an uptick, right? And if this continues to rise higher, this could, be a problem for the U.S. economy. And a lot of these stocks that are going bankrupt are, your smaller businesses, right? It's not your mega cap tech companies. And a lot of these companies are encompassed in the Russell 2000. Now, the Russell 2000 actually went below. Okay. You see this green box right here? That's the demand zone from the October bear market lows. And it actually broke through and went lower than the bear market lows we had last year. So the Russell 2000 has been stuck in its bear market. And that's something that a lot of people haven't been talking about. Now, it has been due for a bounce here, all right? Using some simple Elliott wave theory, we got 5 waves down, all right? We came to that key demand zone, and it looks like they had a liquidity grab here and basically stopped out a lot of people who were going long by pushing it below that demand zone, below those October lows of the bear market. And now we're getting this rally here, right? And we're setting up for an ABC move to the upside. We came right up here to the wave A target here at resistance right around 170. So if we do get a pullback, it would be healthy. If you're looking to do any short-term trades, you could look to potentially buy the dip at 165.90 or 164.89 with, some type of a stop loss below, of course, looking for a break back above 170, potentially all the way up to the 174, 175 area. But as always, the content provided on this channel is just for informational and educational purposes only. It is not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer. If you're new to the channel, I started a completely free newsletter for you guys, Investment Intelligence. Link is in the description, giving out free valuable finance content as well as free trade ideas. I try to sprinkle in 1 or 2 trade ideas a week. And this is what it's going to look like, right? We're going to go over the conditions and the chart and basically describe what we're looking at here. Okay. And you can see that this trade played out very nicely. I did one on home builders a couple months ago too. All right. Not all trade ideas are longs. There are short ideas in here too. This was on, many different home builder stocks and ETFs. And if you take a look, the XHB home builder ETF actually dropped about 18.5% from its recent highs. So that was another really great trade idea there. This is one on Stanley Black & Decker, highlighting the rising wedge, identifying where we think the stock can come down to and some of the targets, and you can see that played out as well. So if you're fans of free, valuable finance content as well as free trade ideas, you're going to want to sign up for that newsletter using the link in the description so you can get those straight to your inbox. And if you want access to all of the trade ideas, okay, you can always join the Investment Intelligence Discord. There's a link in the description for that. And many of these different trades, work out well, especially if you trade options. Now, options are extremely risky. So, you do have to manage your risk accordingly with any type of trades or positions you do take. Now, if you ever feel like you need that extra one-on-one touch, all right, and maybe you have some questions you would like answered or a more interactive, session, you can go to my Ko-Fi page. There's also a link in the description for that, and you can book a 30-minute and 1-hour session. I do those all the time. You can request a YouTube video, basically on the topic of your choice. And you can also click on this buy a coffee button, basically as a way to leave a tip or a donation for the free content I do put out for you guys. Now, let's get back into the data and we take a look at Philadelphia manufacturing. The headline index improved basically from -9 or to -9 from -13.5. New order shipments and employment all flip positive. Prices paid and received point to increasing prices overall. So, this could be something that ends up leading to inflation coming back. But this is one of the things that Jerome Powell, when he spoke about, does he see a recession in line anymore? In his recent FOMC meeting, he said that no, that they took that out, right? And we're going to see that once they release the Fed minutes. And this is some of the data that they're looking at, right? And using to support this evidence, basically, that we may actually not get this recession. We may have skipped the recession. Now, I know that's not the popular opinion, but I just want to show you guys some data behind why people are saying things like that. Now, if you take a look at the conference board leading index, okay, the leading indicators have fell again, marking the 18th consecutive monthly decline. So this is more of the opposite argument, right? Basically, a lot of leading indicators are saying that the economy doesn't look good, that we are actually going to get a recession, right? So there's lots of mixed data out there, right? If you're a bull, you can find bullish data. If you're a bear, you can find bearish data, and that's what makes it so hard to navigate the market. If we take a look here, this is again from the conference board leading index. We see the underlying leading index components for September showing nearly all negative/flat except initial jobless claims. Pretty much sums it up. The US jobs market has been resilient, keeping the economy from meaningfully deteriorating further. So we're about to get the October report here now that October is finished, and we'll see how things have changed in this, and any developments that we need to basically be aware of or look out for, whether it's bullish on the economy or bearish on the economy. But again, this is kind of just some of that data that Jerome Powell and others are looking at, saying, hey, well, you know what, maybe the economy is doing a little bit better than we thought it was. All right. Even though we're printing massive amounts of money, even though we're keeping this higher for longer policy, even though that the US Treasury has just been flooding the market with treasuries, maybe, we can actually come out of this unscathed. Now, again, that's not the most popular opinion. I wouldn't say that that's my strongest opinion, but we'll see how things turn out. Okay. Now, if you look at commodity prices, industrial commodity prices have broadly normalized into the range of the 2010s. Food-based commodity prices remain elevated relative to their 2010s range. What's really interesting is that we've actually been in a commodities bull market. If you take a look at the CRB, or basically take a look at a commodity index compared to the S&P 500, like a ratio chart, you'll see that commodities actually have been outperforming the S&P 500 as of late, or relative to the S&P 500. Now, if you look at high yield and IG investment grade volatility, the CBOE, right, Chicago Board Options Exchange, has launched 2 new measures of implied volatility for IG and high Y, and they show that credit volatility has increased recently and remains above pre-pandemic levels. This doesn't really surprise me. It's something that I've been mentioning for a long time. And if you just take a simple look at the MOVE, all right, MOVE index, this is basically your bond market volatility index, right? So basically the VIX for the bond market, and the MOVE is elevated above the VIX, right? We've actually seen more volatility in the bond market than we have in the stock market and in the equities market. And it's been something very, very historic, right? I mean, people are going to really look back on this many years in the future and say, wow, what a crazy time to try to be a bond investor, or what a good time to be a trader, okay? Because traders love volatility, right? If the markets are not volatile, it means that there's not big moves to the upside or to the downside. And as a trader, we need to love this volatility and embrace this volatility, okay? And basically accept it and know that with volatility comes really good trade opportunities, right? And it's just our job to identify those different opportunities and take advantage of them, right? If you take a look here at the HY and IG short interest, we've seen a massive uptick in short interest for the LQD. Note that HYG stays at relatively elevated levels. So your HYG basically has stayed heavily shorted. And we've seen a massive uptick in short interest for the LQD. I think this data set is slightly old, okay, a couple of weeks old. So it's really interesting to see if we've seen a change in this, and if we've seen some of these bond instruments and bond ETFs start to bottom potentially. That's a big question, is whether or not yields are going to continue going higher. Powell was more dovish than he was hawkish in his most recent meeting, and we have seen Treasury yields start to fall. We've seen things like TLT rise. HYG has been, I mean, that thing literally took off. If you go take a look at that HYG chart, and if we see here the HYG versus TLT, your high yield, basically corporate bonds, all right, have held up much, much more than the TLT, right? I mean, this is back to the October lows of the stock market, and TLT is actually negative. Meanwhile, HYG is actually positive. So, and so your high yield corporate bond ETFs, right? What are going to be some high yield corporate bonds? Well, Apple, right? I believe Apple is paying around 5 to 6% on some of their bonds right now. A higher yield than the actual 10-year Treasury. So the big question is, when people talk about risk-free returns, okay, and what they mean is like, oh well, the government is going to guarantee you that they're going to pay you this yield, right? Well, ask yourself one question: who do you have more confidence in lasting, right? And who do you actually believe more? Who is more truthful in your opinion, right? Is it Apple paying a slightly higher yield, or is it TLT, right? And is it US Treasuries with the government? We're not going to get too political, but that's a question you want to ask yourself. That's a question investors have asked themselves, and that's why I think we've seen high yield corporate bonds in the HYG ETF hold up a lot stronger than TLT, right? Basically, to summarize this in a very simple sentence, U.S. investors, not even U.S. investors, but investors are demanding a higher yield to buy U.S. Treasuries, okay, and U.S. bonds. And so they're saying, hey, we'll buy your debt. Okay, we'll buy your debt, US government, but you're going to have to pay us more, right? And that's been a large factor in why we've seen the TLT continue to drop, and especially relative to the HYG. Again, as I mentioned, the HYG is actually positive from the October lows. Meanwhile, TLT is negative. Now, cash is not trash, right? The best performing major fixed income asset class in the world is US cash. Okay. And so when you take a look at the total return performance of global financial assets years to date, right, you have the NASDAQ, S&P, you have oil, gold, all of these different things in here, Brent, okay, and take a look at US T-bills. US T-bills, baby, cash is not trash. And, one thing that I often try to remind people is, I try to remind people that cash is a position, okay? So not only just in the form of T-bills, but also you don't always have to feel like you need to make the next big trade or you're missing out on a current trade, right? Maybe if you miss a move, you don't chase it. You don't have to chase it every time. There's always going to be a new opportunity in the market. Now, if you look at cash versus the S&P 500 for the first time in the century, cash pays a higher yield and interest than the S&P 500 does in earnings. This is T-bills, basically looking at the S&P 500 current earnings yield and the 6-month Treasury bill yield. This is crazy, guys. I mean, we're literally seeing T-bills pay a higher yield than the S&P 500 current earnings yield. All right. If you look at the dollar versus the U.S. Treasuries, the Dixie and U.S. yields have moved more consistently over the decades, unless when the Fed is not credible or the U.S. U.S. exceptionalism. Okay. And so if you take a look at this era right here, you have the oil shocks, then you have, Volcker. Everybody knows about Paul Volcker. Then you have globalization here. This is the .com bubble. So the US dollar in this graph, in this chart, is going to be red. The US 10-year is going to be in blue. And so they relatively track the same, okay, except in certain periods, right? And you can take a look here, and this is basically kind of what we're seeing, right? We continue to see this trend and see this happen. When we look at the zoo, all right, the ZEW survey respondents are increasingly pounding the table on their call that U.S. long-term rates are headed lower. We've started to see that, and we're seeing lots of people saying that, right? I mean, I'm sure if you watch any type of other bond videos, right, on the TLT, everyone is saying that TLT has bottomed. And they've probably been saying that for, I mean, realistically around the past year. So, Maybe it's beating a dead horse. Maybe we actually have bottomed. Who knows? We'll have to see, basically if that's going to happen or not. But, you know, treasuries are not bad. Okay. And if you have a long-term time horizon, and you actually do think that interest rates are going to come down, and you're not trying to time the market and say that interest rates are going to come down, in the next, 6 months or in the next year. But if you have a longer term time horizon, I do think eventually we will start to see yields go back down again. The big question, of course, is when, not if. And bonds are actually attractive for the first time in many, many years and decades. Really, we're actually able to get attractive yields on bonds and on US Treasuries. When you take a look here, the 10-year Treasury continues to rise due solely to higher real yields, not inflation expectations. There's many different takes, right? And so this is one take that I wanted to throw out there. I keep pounding the table that it's more of a supply issue. It's just simply supply and demand. And we have the three biggest factors of demand out of the equation right now. We have the Fed out of the equation, no longer buying US Treasuries. They're doing quantitative tightening, the exact opposite of quantitative easing. You've got China and Japan, the other two largest purchasers of US Treasuries, both selling off. So when you take into account that the Treasury market has been, flooded, and they've put over $1 trillion into the US Treasuries, or added over $1 trillion of liquidity to the US Treasury market, and you have the three biggest factors of demand, aka buyers, out of there. It's very simple that yields are going to go higher due to the simple factors of supply and demand. But there's many different takes, right? A lot of people have been saying, well, it's because the US economy has actually been strong and it's been showing good data, right? It's now this right here is saying it's because of higher real yields, not inflation expectations. And some people are saying, well, inflation expectations are upticking and we're expecting inflation to come back, so that's why yields are going higher. There's a lot of different reasons. Nobody's necessarily right or wrong. And I just wanted to provide some more perspective on that. Now, Chinese investors offloaded the most U.S. bonds and stocks in 4 years in August, right? And so this is kind of just, giving you guys some data behind, so you guys know I'm not just making stuff up. China has been selling tons of U.S. Treasuries. I mean, it's just a simple fact. And they've sold the most U.S. securities in August that they've sold in 4 years. It's that's why it's been so tough, right? I mean, that's why TLT has really been, a falling knife for a lot of people, and we've been seeing it rally, and hopefully it has bottomed. I mean, we would all love that, but we do need to be cautious, right? And maybe it just consolidates, right? We've seen a strong rebound. Maybe it's an overreaction and it pulls back and cools off a little bit. I mean, that wouldn't surprise me. Ultimately, I think between $80 and $89, I think that could potentially be a new range, and we kind of just chop in between there until we get some further clarity on direction on whether or not it's actually going to break out above that 89 level and start to start a continued rally and really break the downtrend, or if it's just basically trying to find an area of consolidation between that $80 and $89. Now, Chinese holdings of U.S. Treasuries dropped again, sliding by another 16 billion, the lowest since 2009, and down a record 20 of the past 22 months. All right, so again, seeing massive selling from China in U.S. Treasuries. Okay. Now, October looks set to be the third month in succession of ever greater portfolio outflows from emerging market equities, on some measures reversing all inflows since the start of the year. And so, basically what this is telling you is that, people are not interested in emerging markets, right? In other countries, and, emerging markets like Brazil or India, for instance, they just don't want anything to do with that, right? We've seen a lot of inflows into bonds, right? And as I explained, even though we're seeing lots of inflows into bonds, at the end of the day, is it trillions of dollars worth of inflows into bonds? Well, no, it hasn't been. That's why we've seen bond ETFs continue to drop lower and lower. It's just because of the simple fact that, yes, there is a lot of demand, and it seems like, everyone and their mom is buying, bonds and buying TLT. But at the end of the day, there's just been much more supply than there has been demand. that's pretty much going to wrap up today's video. Just wanted to go over some economic data for you guys, keep you up to date on, what's going on in the economy and the markets. Hopefully you guys enjoyed today's video. Don't forget to sign up for that newsletter using the link in the description. Smash the like button, subscribe to the channel for more.